Welcome to Talk Tickers. Today we're jumping right into Kimbell Royalty Partners' third quarter earnings call from November 6, 2025.
Okay, so let's get right to the headline number. Kimbell posted a really solid beat on the bottom line, reporting earnings of 19 cents per unit. Now that came in well ahead of what the street was looking for, which was kind of clustered right around 13 cents. So, a very clean, very nice beat.
But here's the weird part. Despite that strong earnings print, the market basically shrugged. The stock barely moved, closing up just a tiny fraction of a percent. So what gives? Let's dig into the details and figure out what's causing that disconnect.
First things first, let's get grounded in the key metrics from the quarter that drove that bottom line performance.
You know, what's really interesting when you look at this table is the contrast. Yeah, revenue is down a bit, and pretty much what everyone expected. But the real story here was that very strong production number. That's what fueled the big earnings beat, even as they had to announce a cut to the distribution.
And let's be clear, that 19-cent EPS print wasn't just a small beat. We're talking about a beat of roughly 50% against what analysts were expecting. I mean, by any measure, that is a very, very strong result for the quarter. Now, for the income investors, this is the big one. The new quarterly distribution is 35 cents per unit. And while that's lower, it still means you're looking at a forward yield of 10.7%. That keeps Kimbell squarely in that double-digit income category, which, let's face it, is a core reason why people own this stock.
And operationally, the engine of the business was really humming. Production came in above their own guidance at over 25,500 barrels of oil equivalent per day. That's up a really healthy 7% from a year ago.
Okay, so with solid operational results, what was management's message on the call? Well, their tone was pretty upbeat about the business, but you could tell they were being cautious financially.
The word of the day was definitely resilience. Management hammered this point home over and over. The idea that their diversified portfolio delivered real, organic growth even when commodity prices weren't helping them out. They see it as proof of the quality of their assets.
They kept coming back to their asset-light, royalty toll booth model. And this really illustrates their whole position perfectly. Just think about it. They've got interest spread across this massive footprint, and they benefit from all 86 rigs that other companies are paying to run without having to spend a dime of that capital themselves. It's a pretty sweet setup. So what about the elephant in the room, that distribution cut? They were pretty upfront about it. They framed it as a strategic trade-off, a deliberate choice. They're choosing to keep a very high yield while actively using a quarter of their cash flow to pay down debt faster after that big acquisition they made.
And this is a really crucial point for the outlook. They reaffirmed their full-year guidance. They're confident because they have this huge backlog of drilled but uncompleted wells. Think of them like finished products sitting in a warehouse, just waiting to be shipped. It gives them clear visibility on production for the rest of this year and even into next.
So, if the operations are sound and management is confident, why is the stock stuck in the mud? What's holding it back? Let's dig into the market's perspective to find out.
And wow, this chart right here really tells you everything you need to know. Despite that high yield and the solid operations, Kimbell has gotten left in the dust by its peers. That's a huge performance gap, and that's the kind of thing that makes investors really nervous.
So this brings us right to the heart of the matter for anyone looking at KRP right now. It's a debate. Is that massive double-digit yield enough to make you overlook the risks of higher debt, more units being issued, and a distribution that's been trending down? And that M&A deal is really the key to understanding this whole story. They made that huge Midland Basin acquisition to start the year, which was great for growth, but they paid for it with debt. That pushed their leverage up to 1.6 times, and that in turn is exactly why they've had to cut the distribution to pay down that debt. It's all connected.
And remember, none of this is happening in a vacuum. The whole sector is facing some tough headwinds. The U.S. oil rig count is way down from its peak, and the price outlook for next year isn't giving anyone a reason to get super bullish. Right now, the market wants to see companies pay down debt, not just pay out big yields. Okay, so let's put it all together. You've got strong operations on one side and some very clear market concerns on the other. Here's our take on what comes next.
We see the path forward for Kimbell really boiling down to 3 key points.
First up, Q4. Honestly, we expect a pretty steady, maybe even boring quarter. Production should track right along with their guidance, and we fully expect that distribution to hold right here at 35 cents as debt paydown continues to be the #1 priority.
Second, what does that mean for the stock price? Well, we think it's going to be stuck in a tug of war for a little while. It's caught between the floor provided by that juicy 10% yield and the ceiling created by all those macro and balance sheet concerns we just talked about.
So,
That brings us to the crucial point. Our rating is market perform. The story is just too balanced right now. You have a really compelling bull case and an equally compelling bear case. And when that happens, a stock usually just ends up treading water for a while.
Now, for a potential trade idea, if you're looking for an interesting angle, try thinking about KRP not just as an oil play, but as a high-yield, leveraged bet on a natural gas price recovery. Gas is half their production, and the market often overlooks that. If you believe the story about LNG exports and power demand taking off in the next couple of years, and gas prices surge, Kimbell's cash flow could absolutely explode higher from where it is today.
This is not financial advice.